So what's up, everyone?
Hey, Tim.
I, Matthias, I
Guys.
just want you to know that like everyone's joining for you. Okay, there's like not even close to this many people who join when it's just me. So they heard that big guns were coming on, and they said we better not miss this one. Everyone else to hell with it, but this one's the good one.
No problem. I'll send you my invoice later.
Okay, that's good. That's good. Oh shoot!
Thanks for the hype. I appreciate it.
All
Hi, everybody.
right.
Hi, Michael.
What's up, everyone? People are just joining. I don't know why I have to admit people from waiting rooms on Zoom now, but I'll figure it out eventually, or I just won't, and I'll just live with it.
It's actually
Anyway,
in their sweating. It's in their settings, Tim, not yours. They have to be logged into their Zoom app in order for you to not get that invite request to admit them.
oh, no, that's good. That's good. I've been meaning to blame more people and not take any of the blame myself, so that's perfect.
You got it. You got it.
It's just because you're important. That's the only reason why.
Oh my gosh, don't come on now. Um, all right. Well, I'm sure people will keep joining, but thanks everyone, for coming on. This is like a every 2 week mobile home park acquisition call, just to discuss, how can everyone best acquire mobile home parks. I don't know a smarter way to say that. But yeah, so I've had like a ton of people ask me how I underwrite parks, and my answer is I don't. Matthias underwrites them to make sure that we're actually doing things correctly instead of just BSing things like I have for so long. So I asked Matthias to come on board to basically break down everything underwriting wise, and teach everyone after this is being recorded, so after, like, I'll throw it on YouTube and everything so you guys can watch and get all the nuance. But yeah, that's all I've got to say. Take it away, Matt.
Sounds good. Thanks, everybody, for joining. I'm humbled by the attendance. I love it. That's great. And I also see Victor, a big shout out for having a baby in the call. I love that. Teach him young. I love it. Love it. We recruit him young here in this call, Tim. I love it.
He just
That's
came
great.
back from the gym too.
What's that? Sorry, I didn't hear you.
He just came back from the gym. We were at the gym and now we're on the phone.
Love it. Habits define your future. I love it. That's great. Gym and then underwriting. Sounds like my day every day. All right, guys, let's get started. So just a couple of things. I want to just set the mindset here that's needed for underwriting, right? Especially mobile home parks. Underwriting is more of an art than a science. So it's more about it's more than just putting the numbers into the spreadsheet and waiting for the numbers to go green. There's a lot more to it. So you have to really look at all the numbers. You have to look at the history of the asset and see where it was in the past. And where's it going? So if you're lucky, you get some nice financials from these guys, from the brokers or the seller. Just look at how the last couple of years look like. You can see kind of a trend and see what's happening with the deal. I think that's very important to also look into before you put the numbers in. I'm going to run you through a couple of bullet points, basically, of what I do before I even get started on the underwriting. So again, it's not about just like throw numbers in the spreadsheet and hope for the best and then let the numbers turn green. It's more than that. So I know we have some people here that are probably new to this, to underwriting in general or mobile home parks. So I'm just going to also go through terminology so everybody understands when I say TOH, POH, and so forth. So TOH means tenant-owned home, which is basically when a resident or a tenant owns the trailer in a trailer park and they only pay for the lot rent, for the land, basically. And then we have POH, which is park-owned home, where there's a second income stream for the lot itself, where the person pays for lot rent and also pays for the home if we, as a landlord, own the trailer. So that's a big difference there. So there's two income streams on one pad in that sense. There's also RTO, which is rent to own, which is kind of basically selling the trailer from a park-owned home and selling to the owner, which we go into in our underwriting later when I can show you some numbers, how that looks like and how this is very attractive. And one of the strategies that I'm deploying with Tim right now on a couple of deals. So those are the terminologies. T12, trailing 12. That looks like we're looking at the last 12 months of financials. That could be also, I've received T6s, T8s, T9s, whatever you want to call it. Ideally, you want to have T12s. You see some history. Be careful when you look at stuff. Be critical, very critical. I get stuff sometimes that's completely miscalculated. I think Tim and I just had a deal in Colorado we looked at, and the broker came back at us kind of snappy and said, you guys are full of it, and this is wrong. And he looked at their T12, and actually they prorated, they're only about 8 months of data in there, and he prorated it completely wrong and overinflated his NOI. And I caught that in the underwriting. So we gave him a certain value, which he wasn't happy about. And yeah, you have to discover stuff like that. So just don't take the numbers. Make sure it's recent. It could be also a number that's from 2021. We had that recently with an RV park. Looked pretty decent on the financials, but it was from 2021, which doesn't really help because everybody knows what happened in 21. Everybody was in a traveling frenzy. And if you're underwriting an RV park, it would look fantastic on those numbers. But 2022, 2023, and 4 is probably a decline there. As soon as we asked for updated financials, yeah, we didn't hear anything anymore. We got ghosted. So they kind of gave us the answer. It's probably not a good performing asset. So what I want to give you on the road is be critical, ask questions, be nice about it, be professional, of course. You want to build relationship with the brokers, but be critical about those financials. That's very important. You talk about expense ratios, right? So for the tenant-owned homes, TOH, you look at like 30 to 40% expense ratios, which is low, of course, compared to our apartments, for example. On the park-owned homes, we look at like 40 to 50%. It really depends on age and condition. This is really important too to know. If you have a really old 70s, 80s trailer, you're probably like in the high 50s, even or 60% range. But it also depends what tenant base you have, how hard they're on the trailer, you know, what kind of trailer it is, what manufacturer, etc. So you will hear that word a lot today. It's my favorite word in real estate. Depends. It depends on a lot of factors. So especially mobile home parks. But that gives us a lot of opportunity to move a lot of levers and, you know, make the deal better and, you know, and be creative and stuff like that, which you will see in a minute. And I'll run you through one of my underwritings, which makes me passionate about and Tim passionate about this asset type, because there's a lot that can be done here. So before you start, make sure you have everything right. You have to have a ratio of the tenant-owned homes and the park-owned homes. It's really important because you need to understand how many of those lots that you have are actually, of course, occupied, and also how many of those are park-owned homes and how many are tenant-owned homes. Very important. Also make sure, ask the question, how many of those park-owned homes are perhaps on a rent-to-own contract? The reason why you want to know, you don't want to buy an asset where they have already been on a rent-to-own contract for 10 years, and all this income is going to drop off next year because they're all paid off, and then you're just stuck with the tenant-owned homes, which can still work because we will see in a minute why. But we have to make sure we cover our bases here. That's more a due diligence topic, but make sure you ask those questions up front. Make sure you have pictures if you can. Do a drive-through on Google just to see the area, because you can get an idea sometimes. Sometimes you're lucky to go through the park and you can see the condition of the trailers. Make sure it's recent. It's not from 2019 or something. A lot can happen in a couple of years. Make sure that's covered. Also, make sure you understand the utilities. Are they private? Are they public? So you want to have ideally city sewer, so you're really just responsible for the plumbing that goes into, you know, the city lines, and then from there the city takes it. There could be a lot of sewer, electrical, gas lines that could be your responsibility. So you want to make sure those are checked also during the diligence. Ask those questions for underwriting, because if there's repairs necessary, you want to underwrite for that, obviously. The same goes for, like, do you have septic? Do you have a lagoon? We usually stay away from lagoons, but there could be city sewers, which is ideal, of course. There was less liability there and less cost for us. So make sure you have this information. And always take the information from the broker with a grain of salt, right? So don't just take it and run with it. It's not like they're lying, but they have a lot of deals going on. Some may lie, but they're just busy. They're juggling a lot of information. There might be, you know, giving you misinformation, but it's your job to do underwriting properly. And you're the shepherd of the investor's money. You have to make sure you underwrite it correctly so you can get the returns that you promised to people, right? So the last thing is make sure you know your market. If you don't, make research, right? If you have an asset in front of you, like a mobile home park, and it says, well, it's 50% vacant, you have to ask the question, why is it vacant? It might be it's badly managed, but also look at the market. If you're underwriting 150 unit asset and it's in the town of 500 people, it's very likely it's half empty because there's not many people want to move in that place. But if it's half empty and you're in a big city with 500,000 to 1 million people, very good chance to get that thing filled up. It's probably just badly managed. But it goes back to my first point. It's an art and not really, you know, science. You have to really see the story, see what's going on, and make sense of the numbers while you're putting all the information together. So it can take a while, but that's important because we want to make sure we do it right? I'd rather, sharpening my axe for 4 hours if I have 5 hours to cut a tree down, because I can do that in 1 hour and don't have to work hard. I have to work smart then, or I do work smart and hard. So that's what I'm aiming for every time I underwrite. So little trick as well. I did the mistake in the beginning too. Don't reuse an old underwriting. Always use a master copy that's clean, because you go in there sometimes, and since every deal is different, you're moving formulas, you're moving stuff around, and then you wreck your new underwriting. You realize it later, oh, this is great returns, and then you go in there and it didn't pull any expenses in there properly, or it only escalated by 3% per year instead of 5%, whatever it is. Make sure that's already clean going forward. So with that being said, I can show you how a deal looks like I did just recently with Tim.
Listen, I'm on a call. I'll have to call you back, okay? All right, bye.
All right. Let's see. So share my screen here in a second. All right, you guys let me know when you can see my screen.
Yep.
Perfect. Good. So when I said earlier about making a market analysis, this is how it looks like for me. Can you see that? It's coming up. So this is a different deal. That's what's for an apartment, but it kind of goes with, doesn't matter what asset type it is. I go in there and see how the population growth looks like. You don't want to go into a market where people are actually escaping and actually running away from that area, because you want to have an increase of supply, because they're all potential tenants go into the area. Always make sure also the county has growth. Sometimes the city can have people escaping, but the county can grow, and then you have to look where it is in the county. Make sure you see that as well and recognize that. This is actually a good example. You see actually in the city of Biloxi, in that case, people were actually 13% decline, 12% increase. So it's not terribly alarming, but something I want to look into. But the county itself was growing steadily. So people just moving out of the city, probably going in the suburbs. Something completely normal. But that's why you have to look at both, not just look at one, throw in the trash and move on. Sometimes there's a story behind it. Then you also look at the area median income, which is important, because you want to make sure that the rent that you're targeting is not over 40% of what the area actually has as median income. So that's also very important. The typical ones that you know about, prime, always want to check if there's a battleground or not. Is it surrounded by good areas? In this case here, green is good, yellow, okay, red, not so great. So you want to make sure you check that out. You want to buy something in the battleground. That's very important.
What heat map site do you use, Matthias?
For the crime one, check. I have real estate resource right here. It's crimegrade.org. That's what I'm using.
Thank you.
Absolutely. All right, then I'll do some regular notes. While I'm doing my observations, I'm actually making notes. And this one here, that's why I point this one out as a sample today. I had one deal where the broker gave me the seller's financials, and they actually broke out the property tax and the insurance and said non-controllable expenses and excluded them from the NOI, which does increase the NOI, which does increase the value. But it's just, placebo value. It wasn't really real value there. But you have to catch stuff like this. Maybe the seller did it intentionally. Maybe it's just how they did the internal reporting. Whatever it is, it's wrong. So you have to make sure you catch that stuff. Make sure you're catching all those expense items, because they're extremely important. All right, let's go to the underwriting here. Is it still loading? 1 second. There you go. So that's a deal we currently we're going into. So that's the analyzer that we're using from the Mobile Home Park Academy. So I didn't create that one. But I'm got really accustomed to using it, but I didn't create and invent that one, so I'm not going to take credit for it. So I don't know exactly how all the formulas came into the spreadsheet, but I know how to usually manipulate them and make them work for me and for the deal. So
Tim, this is the one that you send out when people ask you to send them on blank underwriting.
Yeah, because I don't have one blank. So when someone says, "Hey, I need an analyzer," I just send them the last one, because the last one is always the best one, but it has stuff on it. So you might have gotten this, or you might have gotten a different one, but they're all real deals.
Okay. I just like to use the one that you guys like the most.
Oh, yeah. So this full analyzer, I want to say like Brent Nip did this, or God, I forget who. A big player in mobile home park space did this originally.
Got it.
Yeah, I can share that master template. Every time I do updates, I always have when I'm underwriting, that's just me, you guys don't have to do this, but every time I'm underwriting, I do some upgrades, if you want to call them that way. I upgrade the master template right away, so I have a fresh sample of my upgrades for the next underwriting. I'm just getting 1% better every day. That's how I do it.
I'd be most appreciative. Thank you.
Yeah, I absolutely can share that.
Send it to me. I'll email it to everyone.
Will do.
So-
I'll make a note. I don't want to forget.
And then it's like Tim Vitale does, everyone just creates their own copy of it. And then that's so smart.
Perfect. Thank you. All right. So we look at this deal here. It's a 135 unit in Clifton Forge, Virginia, small town. But we looked at the deal. We still actually working with the broker right now, Tim and I, on this deal. But I thought it's a good example because
I'm looking at the PSA in front of me right now, by the way.
Oh, yeah, nice. So we actually trying to get under contract right now. So that's a good example. So what you want to start with, what I start with is always I put the purchase price in there, which is not the price you're actually purchasing it, but I put the asking price in there. And then I fill everything else out and I go to the returns and see, okay, it doesn't make sense. And then I get creative, reduce the price, so forth, and change the down payments, etc. So I put that in there first. I put in the total lots. So on this one, you have 135 units. So I do total lots 135. And only 112 had homes on them. So I did 112. And here's a mixture of tenant-owned homes and park-owned homes. So here, back to the terminology I mentioned earlier, POH right here, and it shows how many are vacant. So in this deal, there was a lot of vacancy. So we looked into this, why there's a lot of vacancy. And also the data we've gotten from them was bad. So don't be surprised. Don't be surprised with the mobile home parks. You get all kinds of really, really interesting information. I mean, this OM was like a page and a half or page and a quarter. The front page had all the pictures, and there were like only 2.5 of them on there. They looked like they were Polaroid scans. They were really bad quality. I mean, you get all kinds of crazy stuff. I got financials on handwritten napkins before on previous deals. Sometimes you get financials 3 years ago, like I mentioned. Just again, be critical, ask if they have more. If they don't, make sure you underwrite it in such a way that you making a good deal. So if use the conservative assumption, don't assume for the seller that they have a great deal. They probably don't. There's always a reason why they're selling. So with that being said, I put the amounts in there of the park-owned homes, which brings me to another funny point is I put this here as a joke and I send this to Tim like this, just showing their math. That was a screenshot from their OM. And it showed they have 12 newer POHs, park-owned homes, 29 older ones, and 12 plus 29 is 41. I agree with that. The next one was 0 plus 7 is 11. I was like, what? So again, their math was wrong. So you have to catch that stuff. They put this together. Whoever slapped this together had probably just 12 minutes to do it. That's how also the OM looks like. Make sure you catch that stuff because that makes a big difference. If you just take the 11, you have 4 park-owned homes missing in your underwriting. So it's extremely important to catch that stuff.
Even with bigger brokers who put together really nice looking OMs, still I've seen inconsistency. So yeah, you definitely have to catch that.
Exactly. Then you slap a value behind it. So I have like a little cheat sheet we can also share with you guys. Let me make a note. It's a little bit outdated. I think Vanessa, you on the call, sent it to you yesterday. I hope it was helpful. So that shows like an overview by age and what the typical values are. But again, my favorite word depends. Depends on the condition, location. Is that thing in Florida? Is that thing in South Carolina? Is that in New York? I think there's different variables. What I like to do, I like to go in the Facebook Marketplace and in the market I'm looking for and just look what the values roughly are for a rehabbed park-owned home or just something that's used, whatever. So you get an idea, and then I put a number behind it. And the reason why we're doing this now, and that's kind of the kicker, that's where the rubber meets the road in mobile home park investing. That's where everybody, including myself, do it wrong in the beginning. I did it wrong too, and I had to get education from Tim how to do this properly. So the evaluation on mobile home parks is depending on the NOI, like any other commercial asset, but only on the lot rents, not on the park-owned home rents. So down below, we'll see this in detail, but you have to see the park-owned homes as inventory. So that's why you want to have a count here. How many are occupied and vacant? What's the value of those? And it splits out the value over here. So basically, that gives you a value what the lots or basically the mobile home park is worth, and then the value for the homes where you're arriving at that park and your purchase price for that park, basically. So once I go through there, I'll probably get an idea what the history is. There's a lot of vacancy, so I assume it's probably a rundown park. We probably have to invest in some infrastructure and some upgrades, whatever it is, and make it a nicer community. So I'll go in there, make some estimates of what repairs and upgrades we have to do. Let's put this over here in the acquisition costs, repairs, estimate repairs on the park, estimate repairs on the homes, and also reserves. You always want to put reserves on there. Depending on the scenario, it can vary between 50 to 150,000 or more, depending on the deal size, obviously. And everything that's in blue here, by the way, that's what you have to fill out if applicable, and everything in red is auto-calculated, right? So just be aware of that also. The loan metrics, we usually go with like a 25% down, so 75% LTV as starting point. That's what we're seeing currently coming through. And the rates were like 8 to 8.5. Again, to be conservative, start with an 8.5 and see how it goes once we get a term sheet from the lender. And we get amortization for 30 years, like 5-year balloon at the moment. So that's what we're going with. So here, again, that's where the rubber meets the road. Very important. So this spreadsheet is at first confusing, but once you get it, you can see how you can play with it and actually make a deal that seems, average and can make a great deal out of this. So in here, this section is just lot rents only. So you're looking at how many can you put in here? 135 lots, right, in total. So this is 3 different categories. So on the left side, this is the reported stuff. You fill everything out you get from the broker, the seller, whoever it is, and fill everything out as is at the moment. The day you buy, that's a day one acquisition, how everything is with the reported numbers from the last 12 months if you have them. Then if you feel like there's something really badly wrong, I do copy that over here and make my adjustments because I feel like there's something like, again, like the other topic, property tax was missing. So I'll do another version in the middle, my version on purchase, and have this compared to the reported one. And on the right side is the potential in year 1. So the story here is a lot of vacancy, and we have park-owned homes, 73 of them. So what that spreadsheet does, it takes all 133 lots and multiplies it by the lot rent. In this case, we're going up from 316 to 360 in year 1, gives you this revenue. You're deducting 10% vacancy to be conservative, usually 5% with like 135 unit count, you get down to 5%, but we have to calm down from 35%. So we were like, okay, let's be a little bit conservative. And after year 1, we're going to be 10%, then we go down to 5 in year 2. So that's why we did it this way. When you go down to this year, you will see, well, 73 times 510 4 years, more than 131,000, and you will be correct with that. What this does, you're actually deducting the lot rent from the park-owned home rent. Because again, like I mentioned earlier, you have 2 income streams per lot. You have the income stream for the lot, and you have the income stream for the home. And there's a gap between those two. And sometimes it can be wide, it can be $400, $600, $700, depending on the market and condition, etc. And sometimes in this case, it's less than 200. But you can make that gap wider. You can play with it if the market allows. So what it does, it puts it all together. But the value basically in the end with the NOI is created from the lot rents only in the end, right? We go to that in a minute here in the other tabs. Another one what's really important, which applies not only to mobile home parks, but also to apartments and other commercial assets. Always look into what they're paying on utilities and what they're actually charging back on utilities. Sometimes they bake it into the rent, so you can't really see it, but it's good to ask the question. But sometimes you can see it broken out, which is great. Then you can see, okay, does it even match what they're charging back, what they're actually consuming? Again, depends. Because sometimes you cannot just charge a tenant back $100 and $125 a month on utility fees. There's probably a leak somewhere that has to be fixed or whatever. But you can, with a good conscience, you can charge back $35 to $50 a month, per tenant on utility bill back. So what you have to keep in mind, if you do a heavier lift like this one and you're fixing the problem of getting the vacancy down and the occupancy up, your utility costs will increase, right? Because you have more people in there. Right now, we have 135 lots, but there's 35% vacancy plots on this property. So you have to make sure you catch that. You just put the numbers in, you won't catch it, and you will catch you off guard later when you actually run the asset. So that's very important. So in this section, again, it's broken down in 3 different segments, right? 3 different columns. And what I'm doing here, I'm comparing it and see what makes sense. And then, of course, like real estate tax, as you know, as soon you acquire a property, usually the taxes go up. Makes sense. The insurance here, this section here is all the lot rents only, because that's where really the money is made on the lot rents. So this is all the expense for the lot rents, what I just have highlighted. You don't look at the park-owned homes here. I have people telling me that I'm full of, guano crap, whatever. Because the real estate tax should be much more if you have 100 something, park-owned homes or whatever, or the insurance should be much higher. The reason for that is it's all down here in the park-owned home expense ratio because it's all separated. Again, back to my, topic earlier, we're looking at this as inventory, right? Of course, we have to account for the expenses, which we're doing, but we mainly looking at the lot rent and the lot rent expenses to determining the value of the property. So when you go through this, you get your total expenses down here, and you get the park-owned homes expense ratio down here, which calculates then the net over income on the lots only, and then the NOI for the park-owned homes. And then this here, I actually added this just to see how, in general, how it performs as an NOI in all operations, but this should not be used to determining the value. So in the next tab, this is acquisition costs, your closing costs, appraisal costs, if everything is in there. For attorney fees or the syndication, you probably have a higher cost, obviously, than when you have a joint venture. So you have to massage that a little bit depending on the deal. But everything in blue has to be entered. Everything in black is going to get automatically calculated. The executive summary, same thing. It's just summarize everything, so you can actually take it out, put it into an OM or put it in an email and give it to potential investors and create a pitch deck, etc. And everything here in blue can be adjusted. So we're intending to do syndications. We are actually in a syndication right now, Tim and I, and this one will be one too. And then we charge an acquisition fee, which is usually 3%. So this is right here calculated. We do have a capper at 9 at resale. This, of course, depends on market, but we like to decompress it over time. Usually it's, at purchase or when we sell, it's probably like 7.5 to 8.5, but we have 9 in there. We have it decompressing the time at the time as we own it, just to make sure we don't, overestimate our sales price in the end. That's basically what it is. Very important at the bottom here is the member and managers split. So here it's a 70-30 split, 70% to the members, which is the investors, and 30% to the managers, which is the GP team. For example, me and Tim and others that are bringing on the deal. We intend to pay a 8% return, preferred return to the investors, and 2% asset management fee, which is pretty standard. And then if you refinance within the 5 years of the whole period, there was a 1% capital transaction fee. So you have to fill this out, make sure you adjust that accordingly. And then you can move into the pro forma, which then takes what you filled out in the first tab, and then it moves along for the next 10 years. So right here, you actually have to go in and then escalate or accelerate your rent over time. Right here, we have the first bump was about like, what was it, $50 or so we have on the first one here, which is conservative. We are less than that. We don't like to go over $75 more lot rent right out of the gate on year one. Several reasons for that. First of all, it's kind of unethical to go higher. You have to think about those are low income tenants. If they are living in the trailer they own, it's cost about what, $4,000 to $5,000 to move a trailer. It would be unethical to say, sorry, poor person, you have to pay now $200-300 more a month. Deal with it. I know you can't move because you don't have $5,000. Here's the bill. If you don't pay, we evict you. It's kind of unethical. We don't want to be slumlords, right? We want to provide housing, clean, safe housing, make a business out of it so everybody wins. So we're looking for win-win situations. Also, our lender doesn't like it. The lender says they don't want to end up in the news, because it's unethical to do this as well. So we never go more than 75 out of the gate on year one. And then usually we trickle it down. If you're way under market rent, the deal we have with Tim and I with Gruenwald and Spartanburg here in the upstate South Carolina, we actually about 130, 140 in the market out of the gate. So we actually won't even catch up to market until year 3 because we go 75 in year 2, and then we slow down and go to 35, 25 per year. So you put this in here and then it goes up over time and also automatically increases your expenses over time with inflation with 3%. So as you do this, go in here and see as you're performing better than the previous owner, you can play with those expense ratios for the park-owned homes down here and get them down. I wouldn't go lower than 40%. I start out at 50, assuming it's very high and probably something that they're currently operating at. And I compare those numbers with the financial I'm getting from them. So always compare that to make sure it matches. And from there, you massage it. But it has to be, right? It's an art, right? You have to kind of dance a little bit and make sense of it. So when we go into, we don't have to look at the loans. It's really just an amortization calculator. Let's jump into, let's see. Well, I actually can look at the pro forma because I think it shows the value down here. You can see how the value grows in the pro forma. And if you look at the formula right here, it just takes the cap rate and the value or the NOI, excuse me, on the lot rents only. So now you can see if you would, let's say, let's do a nice comparison here, right? I go in here, and what I'm doing is I'm gonna combine those two and divide that. Let's say that's a 10 cap down there, so it's a 10 cap. So actually would be, let's do this in dollars, please. I will be $600,000 off value in year one. That's why it's important. We have to make sure we're only using this metric right here. So with the park-owned homes, you're still making that money, right? And that's great. You're still cashing that money. But it's all the shell value that you're really paying for is just buying the inventory, basically. And that's why mobile home parks cash flow really nicely as well. One of the many reasons is that you have that park-owned home rent on top of it. And I think, Tim, you mentioned that to me too recently. I think some appraisals look at that too, in a sense. Maybe you can speak to that, like the park-owned home income, but it's not flowing to the value, but they consider it if you're close to where you want to be, like at a refinance, for example.
Did you check out the appraisals for the Spartanburg deal that we're doing on all the parks?
I checked out some of the highlights, but I think all combined is like 700 pages or so. So I didn't read them all yet.
What do you mean? Come on, man. Come on.
Yeah, I do it my
together.
vacation next week. I'm going to sit on the beach and read 700 pages of appraisal documents. Is my plan.
Yeah. So the high level of the appraisals, it said, this is the value as is for the land. And then it would say, here's the park-owned home component. So I think maybe in the future, what we need to do in terms of the value is come up with a shell component for each one of those park-owned homes. And then so say it's, in the appraisal we got for Spartanburg, there's whatever, $1 million and then $300,000 of value in the park-owned homes. So yes, the $1 million is the cap rated, lot rent based, lot rent based only. But then, we still got to add in some kind of $300,000. Is it there already? Am I just
it's right there,
saying something? Yeah. Well,
yeah,
but
it's right there.
So does that have that at sale too?
At sale, no, but I agree. Probably there should be something in there at sale. Yeah, that makes sense. Yeah.
Yeah.
So we have that at the acquisition, of course, but we can. Yeah, that's a good idea. Let me do that. I'll make a note and see if I can put it in somehow in the master template. For sure.
I like to it has it separates income from lot rent and then income from home rent. And though you're not supposed to really, you don't cap everything, it's still cash coming in. It still helps your DSCR. It still helps you not lose sleep at night. For me at least. So
yeah, exactly. Yeah, so what else do we have here? So there's another scenario.
What's up, man? What question you got?
Go ahead.
Hey, Tim. Hey, Matthias.
Hey.
Quick question, guys. When we have the park on homes, and on those we have higher rents, can we just consider the lot rent on those, like for a full underwriting? So if the lot rent was $300 and the park own rent was $500, now we would just consider everybody at $300. Would that make sense? That kind of a adjustment?
The spreadsheet does that. So how that would look like if you put this in here, you would put in here, to your example, 300 and then 500, and the spreadsheet takes a 200 delta out of this here already. So it just looks at 73 times 200 and then 135 times 300. That's how it would do it. That's how it works.
Cool. Oh, okay, cool. Okay, awesome. Thank you.
There's a little bit you can play with it too. A little bit, to an extent. I've seen a portfolio that's up there for a while that one of my friends has listed, and they're trying to they put all these new homes in. They're trying to get $1,000 a month for park-owned home rent, and they're trying to allocate 800 of that to to lot rent, which the market's maybe $350. So it's like that is crazy. If they came in and they're like, yeah, maybe $400 for lot rent, then that that could be seen as doable, like as semi-realistic. The other way, no bank's gonna look at it like that. Like they're just inflating their numbers to inflate their numbers, and like it hasn't sold for a reason, right? So
Tim, another question. How are you guys approaching like the sellers? Because for the most of the sellers that are not very sophisticated, they are collecting rent of $800, right? And the value of their assets, they are seeing it on the total gross operative income on the $200 on the park home. But then we are doing our underwriting and we're telling them, I'm sorry, but I'm not going to be paying for the home. I don't want it. How are you guys overcoming this objection with those kind of sellers?
So I don't want to detract from just straight underwriting right now.
Mhm.
But come along on like these calls, we'll do them every 2 weeks. I'll love to answer that question because it's just that it's more complex than a simple thing.
Mhm.
And I want Matthias, I want to be respectful of his time and go
Okay,
through
okay,
this
cool.
whole spreadsheet. So let's
Nah,
talk
no
about
worries.
it
Thank you.
later.
Yeah.
Yeah,
That's a
bro.
good question, though. That's a good question for sure. Let's dive into that next time. I love it. That's great.
Hey, Matthias, I have a question.
Yes, go ahead, Brandon.
Sorry, I have a few questions. I didn't know we could just jump in, so I was kind of waiting.
It's funny. I was gonna be like, everyone who's got a question, like how about you do this, Brandon? Put them in the chat so we can go out through them afterwards. So we're not like,
Okay.
getting all off on tangents. So
No
appreciate
worries.
it though, bro.
Yeah,
Yeah.
I'm gonna have this done in 5 minutes, and we can start the Q&A session. I know you guys have some questions, so sounds
Okay.
good, Brandon. Fantastic, awesome. Yeah, just a little bit here on this tab, which is kind of interesting. So if you're intending to buy homes and actually sell them out, there's a feature in here, home infill, which we're playing with in another deal that Tim are working on, which is a really exciting deal. We're trying to get under contract, so you can actually go in here and say, hey, I'm buying 35 homes. I'm planning to rent to own them out. Basically sell them to new residents, basically. And the purchase price 65,000, which is like 50,000 for a new trailer, 15,000 for the infrastructure, and it actually gives you like a value down here, lot income from home sales, because it increases here in the following year your total units, basically. So it actually accounts for that as you're growing that. So you want to put the capital out there, and you have the capital, you have a line of credit, whatever you have, you can put this in here and actually increase that if you have the land or you have the infrastructure. Like that one deal we're looking at right now has 163 units, and I think 104 are empty. And we are looking at it's crazy, but it's in a big city. So we know there's a lot of population there, population growth, and it's just horribly managed. And we are trying to figure out a way, okay, how are we going to structure this and how are we going to infill this thing? And I think Tim and I have been like going back and forth for 3 days now just to find the perfect scenario. So it's exciting. I mean, it's great. It's fun.
Can you put a 6 in there? I just want to see so
it cuts that in half down here. If you do that, yeah, it cuts that in half. You look at this number, it will change now. So it cuts that in half because it means you will need 6 months to sell it after you buy it.
Love it.
Yeah.
Okay. Cool.
Cool. All right, then we have sale park, which just basically summarizes everything, how everything's gonna look like, how much money you make. So in this case, it just takes all the the sales costs into consideration, how much debt you have left, and so forth, and then it just takes the equity splits, and then it just tells you, okay, how much does go to the investors back, and how much to the managers, which is the GPs, and that gets boiled down to the returns tab. So that's the one I'm bouncing back and forth, right? We want to, I put the asking price in there, just for the benefit of for the seller, and just like, okay, maybe it's a good price, mostly isn't, but let's try. Go in there, and then okay, maybe we're at like a 1.5 equity multiple and IRR of like 12%. Okay, well, we have to do something here. Then I go back and get the price down. We can do some, here we could do some, creative financing, right? We just say, well, we're just gonna put 10% down on this thing, and do a 5%, even like crazy 50 M amortization, and just do seller finance on this thing, and just tell them like 10-year balloon, 5-year balloon, and changes the returns. Boom, you have a 3 equity multiple, right? And maybe the guy wants to have 4.1 million, and we say, well, 4.1 million might work if you give us those terms. You get your price if you give us our terms, and boom, this could work, right? That's where you can start to dance a little bit and play with those numbers. That's basically what Tim and I are doing once I'm done my underwriting, and can go back and forth. And this is pretty nice to actually screenshot out and send to investors, or put it in a pitch deck, because it shows like what they can get if they put $100,000 into the deal. Like in this case, how the numbers are in the spreadsheet, will be almost a 3x equity multiple, which means 100,000 turns almost to 300,000. So you can show that to the investors and add this to a pitch deck. And this tab here is basically the same thing on a 10-year horizon, but we mainly do 5-year deals, which we hold them longer if we want to, of course, but we want to return the money, of course, faster to our investors at the later the 5 years. So yeah, and then that's in the end here's like a neat little IRR overview of how everything comes together, how the IRR is calculated. So that's about it on that spreadsheet. So I will open up to a Q&A session. Who's got something?
You're up, Brandon.
Brandon, I think you first.
I got something for you. Yeah.
Nice.
So I just want to clarify something first. So you're saying the rent or the park owned homes, the income from that does not go toward the NOI.
Correct, just for the home portion, right? Just for the home. But the park owned home has also lot rent attached to it. That goes to the value.
Right. So let's say it's 300 for the lot rent, 600 for the home rent. So you have 900. Only the 300 is counted toward the NOI.
Yes.
Only the lot rent is counted toward the NOI. And why is that? If technically it's like if you had an apartment and you're renting it out, you have a lease that says I'm generating rent from this home or this unit. Why would that not count toward NOI?
Yeah, that's a good question. It's really just it would put all those park-owned homes into one capped rate, even though you might have 2017 trailers in there, 1981 trailers in there, and some are run down, some are brand new, some are rehabbed. You put a cap rate on something that has 500 variables. That's why you separate it out and define a value based on what they're worth on the age and the condition. That's the main reason. It's not the main reason, but it's probably one of the main reasons that I know of. That's why you separate those out. And Tim, maybe you have some other comments on that too.
Yeah, because it's not real estate; it's personal property.
Yeah,
so
exactly.
Like,
that too.
Sure, it's still producing the same amount of cash, but it's not a real estate asset. So
Okay,
that's right.
Interesting. Yeah, because I get it from like a rent to own perspective, because it's like, okay, that's going to end at some point and it will not be owned anymore and it won't be able to generate the income. But it was interesting that applies toward park owned homes as well. So so in this case, you're probably financing with a bank. So when you're underwriting and looking at this and you see that your purchase price on the lots only is $3,080,000, it looks like, but they're asking 4.5, and you have that $1 million worth of the inventory, $1,020,000 there. How do you finance the $1,020,000 then if that doesn't, like, if the bank is not going to lend on that, then they're lending, let's say 75% LTV on the 3 million. How do you bridge that gap?
You either find a lender who will lend on it, or you set up a separate deal with the seller to do some kind of promissory note for just the homes, and then you break it out completely.
I see.
So
maybe you
underwrite
finance. Got it.
Yeah, you'd have to throw it in a different analyzer and just do the lot rent only. But yeah.
So maybe you have the seller carry back that other portion or something like that.
If I didn't have a bank that would lend on park owned homes, I'd be like, okay, we can give you your whatever for 3.95, whatever we're giving them. We can give that to you, no problem, but I'm going to need you to carry back all these homes because no bank is financing them. And that's the only way I can get to your number. Because
Gotcha.
otherwise, so the third option would be to get, raise the rest of that capital. And like that,
that's a lot of capital.
Well, it's not my preference. I don't want to raise on personal property.
Yeah.
So.
Yeah. Okay. Another question I had was, how deep do you get into the underwriting before sending an LOI? Because I feel like you wouldn't want to waste too much time on it. So do you kind of just get like T12 rent rolls, OM, run the spreadsheet, and then send an LOI, and if it looks good, then you start going, or if there's a bite there and maybe you get under contract, then you really start going deep into everything else, like the like population, median income, all this other stuff, and obviously property due diligence?
Right, that's a good question. Yeah, I mean, the market, ideally, I would like to know the market first before you go too deep. You want to definitely look what you're getting into. You don't want to go into a market you don't want to operate in, right? So have that, in your back pocket. Ideally, do it in your market because nobody knows the market better than yourself, right? Because you're in it. And then how deep do I go into the underwriting? Well, that's why I'm always pushing getting all the information first and then put it into the reported numbers down here in this left column. Then you can kind of see what the property is worth as reported. And then you will see how far you can take this thing. So in this thing here, you have about $120,000 of NOI you're getting after year one. So there might be scenarios where you say, well, I don't want to pay more than what is worth right now, but like another deal that Tim and I are working on, well, we can get this thing for 1.9, but it's not worth 1.9, but if we're done with it, it will be worth 8 million after a couple of years. So you might overpay a little bit, but you have a huge runway. So you have to look at those numbers a little bit. And then what we like to do is throw a kind of wide net and do like 3 different options, meaning like just straight up, bank loan and raise the down payment. And then we have some seller carryback options, or do the, full seller finance and give them 3 different options. And usually those start with a lower price than like a medium price. And then that one might be their price or even higher. You kind of bait the seller to sell for that price because I see that numbers like, whoa, it's actually more than I'm asking for. Well, it's exactly what I'm asking for. The only thing I have to do is give them their terms. That works sometimes. So you can go deep into this. And I'm honestly, I want to be vulnerable. I'm bad with this too. I go sometimes too deep into the rabbit hole. I take the red pill sometimes. I'm like, damn, that was 2 hours. Dang it. I spent 2 hours on this. I'm probably going way too far on this. So cap your time sometimes and don't go too deep. But make sure you have it right, because you don't want to send an LOI out and then they're going to say, yeah, works for us. Let's do a PSA. And then, 2 days later, you need a $38,000 EMD ready. That's something you have to also keep in mind. I gave you a long answer, Brandon. I hope that helped. Was it good?
Yeah, thank you. And the very last one. I'm sorry, guys. I'm not trying to eat up all the time. For the T12, I've just been getting like a P&L. Is that what you're okay? Is that sufficient? Okay.
Yeah, that's good. That's good. P&L is good. That's better than most what I'm receiving. Sometimes I get tax returns, I get napkins, I get everything. So nothing. So I think that's great. P&L, if you get that, that's good. It's a good start. But make sure it's accurate. Run, if you can, ask for a spreadsheet. Sometimes you get PDFs. It's fine. It's more work for you. Ask them if they have a spreadsheet, because you can run formulas yourself and double check their numbers. Because like I said earlier, they sometimes, maybe accidentally, because somebody fat thing on something, but they might, overstate the NOI. And then you run into this deal and say, oh, this already makes this much money, but it doesn't. Because like one deal we looked at, they only had 8 months of data, and then they prorated it wrong and overstated the income. And it was, you remember that, the Colorado deal? Yeah, and he started to argue with us, and then you called him out before I could.
It's bad when I call someone out and I'm like, your calculation is wrong. Like, come on, bro. Come on. Here's why.
Bro, the amount of, I come from a residential realtor background, and those guys a lot of times are just pulling things out of their ass. And I thought the commercial space was going to be like cleaner and more time. No, like the math inconsistencies you were talking about, already see those left and right. And I'm just like, are we using the same calculator? Are we not understanding this or what? It's crazy. Anyway,
sorry to disappoint you, Brandon, but now it's not much better.
I found out, man. But you know what? We roll with the punches, baby.
Yeah, man, exactly.
Thank you. I appreciate it.
He's got a couple questions. He's asking, when you do underwriting, what are your key metrics you're looking for? So we look for minimum 18% IRR and 2x equity multiple in 5 years.
Right.
I don't really mess with, cap rate today because there's so many variables there. DSCR, I'm looking at least 1.35 because I know where banks are right now. And I know if the deal could be the best in the world, but if it's not hitting the 1.35, we won't begin the bank loan. 1.3 to 1.35, depending. And then yield on cost, I don't even mess with things like that. What are your thoughts on that?
No, not at this point. No, I don't do that.
And for the IRR, when you guys are calculating, what is the app that you guys are projecting to make this sell?
We'll say that again.
When you are projecting the IRR, you have to project what's going to be the selling price of the asset. What's the cap rate that you guys are projecting that the asset's
Oh.
going to be sold at?
Yeah, this one here, for example, we have a 9 cap in here, which is, decompressed, which means it's higher than actually what it really is. You never know what happens in the market, and, there could be a major recession in front of us. So we want to decompress this a little bit and go up to 9, but it's probably more likely than 8 and 8.5. But that 1% can make a big difference. I'd rather be at 9% and land at 8.5 or 8.25, whatever it is, or 8. And that can make a difference of a couple $100,000. So this one here, we did a 9. So you always want to decompress it from what it is today. So I think this one here, the broker said 7.5. Again, the broker said verify, right? So just take that with a grain of salt.
Okay, so then you guys would recommend, like, instead of looking at the cap rate, IRR, and which one was the other one? Was the
It's mainly the equity multiple. So basically,
equity multiple?
Yeah, right. So if an investor puts $100,000 in, how many X they're gonna multiply that with? So 3.19 in this case is 100,000 turns to 319 after it's sold and or refinance, whatever it is, at 5 years. And again, we try to be faster than this, but we're not going to tell investors, we might be able to refinance in 1 year, get everybody's hopes up, and then it might take 5 years or 3. We don't say that. We don't want to do that. So 5-year plan, if you knock out of the park after 3, you look like a hero. So that's how you present it.
Yeah, I have
Okay.
a guy I'm working with right now who's like, hey, what about this deal? Like, we can refi in 2 years and IRRs, everything. And I'm like, I don't like it. I saw, what's it? Joe Fairless speak, and he was like, unless someone asks specifically for the IRR, I don't even tell it to him, because he's like, people are juicing returns with IRRs, refi
Yeah.
in
Big
a
time.
year 2 and look at this great return. I'm like, no. Like, so he was like, this is what you'll get year 1, this year 2, 3, 4, 5, and then your exit. And like, you're gonna 2x whatever plus your money or whatever his multiple is. Like, that's easy. How much am I gonna make? You're gonna double your money in 5 years. Like, I could project a refi in 6 months, and all of a sudden you have a 30% IRR, but over 5 years you have like a 1.5 equity multiple. So like, which would you rather have, bro? I don't know.
Right.
Got it. Thank you.
Absolutely.
Michael asked, when underwriting, are you normally looking for passive income or looking for long-term appreciation, retrade, and tax relief? Michael, tell us more. What do you think?
Yeah, so generally they say, like, when you're investing over a 20-year period, there are different types of investors. Those that are cued in on, I want immediate passive income, I want to grow my monthly so I can sit back and enjoy life 5-10 years from now. But there are some investors that think about, I want a long-term, I look at projects for a long-term hold, in this case 5 years, because I'm going to get my biggest bang for my buck in 5 years. I think the other way, I'm not.
So I think every investor is a little bit different what they're looking for, right? So I think that's really, the investor has to answer that question for themselves, what deals
Right.
they have to invest in. Because home parks are very cash flow heavy. So if somebody wants to retire from the W-2, they would probably like that asset type, but they also get a lot of good tax benefits. So it really depends what they're looking for. I mean, you have appreciation, right? Because it's based on the NOI, like you have in apartments as well.
Well,
So I think
being sneaky, Matthias, and jumping over you, I'm asking you two particularly. That's
me
exactly my
myself.
question.
Oh, wow.
I might be underwriting something now.
Well, I like cash flow. I'm a sucker for cash flow. I love it. So, but I like to hit all of them. I mean, if I can have a steak with potatoes and some other veggies, I'm gonna take them all 3 if I can. But if I have to choose, I take a steak. That makes sense. And then if I get potatoes, it's just a cherry on top with a potato on the side. So does it make sense? So I try to hit.
Understood.
The better the deal, you're gonna have them all, right? And then you have the tax benefits anyway. And honestly, ignorantly, I was thinking in the beginning, like before I started getting into mobile home parks, before I met Tim, I was thinking, well, you just own the land. There's probably not much you can depreciate, which is so wrong. And there's so much you can depreciate with mobile home parks, and it's incredible. And then the cash flow really well, so it fits really what I'm trying to do. Like exiting a corporate W-2. That's what I'm looking for, is cash flow. And of course, don't always think about cash flow, because I think I'm doing the same thing. It's wrong sometimes, because you not only get paid with cash flow, you get paid with tax benefits. You have, if you refinance, you get those, big checks, or if it's sold, you get bigger checks. which you can live on as well, right? But as a W-2
Good
person,
point.
if you have a W-2, you always get this consistent every 2 weeks that income. But it doesn't always work that way. Like those deals that could be quarterly returns you're getting, and then after a couple of years you get a big check or whatever it is. And if you're a general partner, you get a check at closing, because you have an acquisition fee, for example. You get paid multiple ways. There's multiple income streams. So you have to keep them all in mind, not just the cash flow. But I was bad too, always thinking about the cash flow, but there's more coming in from the sides. So keep that in mind.
Yeah.
Michael.
Good input, and
I,
thank you.
I'm
Absolutely, man.
looking for I don't know what the hell passive income is because I've never made it. It sounds amazing.
It's
though.
passive-er. It's passive-er.
Yeah. I mean, I make money when I sleep. I do, but it's not passive.
Yeah.
I like the asset class. I like getting in. I make money from different ways in it while I'm making investors a ton of money, while I'm making it a better place to live for everyone. So that's what I'm thinking, like all of the above. If someone just said, like, hey, Tim, you could have this and get like 8% return on your money, I'm like, it's not where I am right now. Sure, that idea is good. I like that, but I'd rather put my money into a deal that I'm working, be active so I can actively ratchet that money up and 2x it. So, maybe a lot of it is where I am right now. And I like this asset class. I like working it and I like making things better. So
Thank you.
Hey,
Okay,
Matthias.
guys, I got a question for you.
Yeah.
In terms of the underwriting and the expenses, if you don't have some of the information, like a lot of these owners, they manage it themselves. What are you using as assumption numbers for some of the information that you don't have?
So if you go to the underwriting, there is let me show that again. It shows a manual override. Let's see. All right. Do you see my screen, guys?
Yep.
Good.
Yeah.
So let's say you don't have anything. You can do a manual override, for example, and then just put in here a number that works. I have to just play with it right now. Then you arrive at like a 41% expense ratio. It's probably a little bit high for lots only, but that might be conservative enough. So we can do 135, 37%. And I will use that as a starting point, like be a little bit on the high side. Like you on like lots only, you're like 30 to 40%. It really depends what you're all responsible for in the park. I use that as a metric. Just go within the expense ratio, but be on the high side to be conservative. If you're landing under,
Okay.
you're just going to be better.
Okay, so just stay within the 30 to 40% on the expenses if you don't have all the information.
Correct. And then if on the park-owned homes, you want to go between 40 and 50, and I go always 50 out of the gate to be safe.
Okay. Okay, so you're not breaking it out like licensing or whatever, and I use like a 3% for off of the gross income or nothing like that. You're just doing it based off of just the 30 or 40% manual override.
Well, for the ones, if they don't have anything reported or it's really a bad P&L, I do that. But for my own numbers, I like to go in with experience and also the numbers that I know that make sense for this kind of, size of property that makes sense.
Yeah.
Usually if we do a mini or we see a lot of P&Ls, you can kind of tell like, okay, in this state, 100 units, probably like liability insurance, like $12,000 to $15,000. You put $15,000 for insurance in there, whatever it is, for the lots, for example, or repair and maintenance, 5%, for lots, stuff like that. Maintenance, the management is always 5% as well. So that is tied to the gross anyway. You can do that. But for the reporting side, if they don't have nothing reported, I just assume the worst. And that's what they're getting. If they don't give me the data, the seller, they're just going to get a crappy freaking offer. That's what they're getting. Because if they don't help me to find the value, is what they're getting is a lowball offer. Because I have to assume the worst. I mean, if they don't have the financials, how you do anything is how you do everything. If they don't have financials for the commercial asset, I'm concerned already. So let's assume the worst when you underwrite. That's the way I look at it. Yeah.
I'm sorry, I should have prefaced with, your pro forma information, like when you go in and you're putting in the expenses of what you think it's going to be. And that's kind of what I was referring to. But yeah, that makes sense now. You answered my question.
Good. Awesome.
Hey,
All right,
Matthias,
guys.
I got a question real quick.
Yes, Victor.
Your 5-year plan, do you sell off most or all of the park-owned homes, or do you keep some? Because your valuation's based on your lot rent, not your actual, home rent. So do you offset all of them, or what do you do? What's your strategy there?
Well, it depends on the deal, and also if you might have a park where there's a lot of them on you may want to keep them because you get really good rent on those, right? And it's extra cash flow. So it really depends on the deal and how many do you have. Like the one deal that we're working on right now in Greenville, Spartanburg here in South Carolina, Tim and I, we try to sell them all off, basically, like rent to own. So what it does is then you can basically say, well, we're increasing the lot rents, but we're keeping the the home side of things the same, about the same, maybe with a slight increase, sell it off to the owner. But what that does, you're actually conveying the responsibility of repair and maintenance to the new owner. But what it does is it gives them a sense of ownership, to take care of the place better. And you're completely dropping off, the expense rate is going to drop tremendously. But at that point, it's just a tenant on a home going forward. So you drop your expense rate from 50 to 30%. So you have to massage it a little bit because you will probably want to get rid of the older ones. You can have like a really trash trailer and you can give it to somebody for almost next to nothing. But at least you have somebody coming in like a handyman special. They pay lot rent. It's an tenant on home basically, and they fix it up themselves. And they have a home they put their own sweat equity in, and they put in like $5,000 to $10,000 in repairs. But then it's a $25,000, $30,000 trailer because they did all the work themselves. They had a home to live in. So yeah, I hope that answers your question.
Yeah, that helps. I was thinking the same way, but we just acquired our first one, so I was
Nice. Yeah. Okay. Awesome. Congratulations. That's great.
Okay.
All right, guys. Well, I have to jump onto another call. Thank you everyone for coming by. I know someone asked about like, what's the process? Like, how deep do you get into the underwriting? I will say I used to go like very high level underwriting because underwriting is not my specialty. But it was very slow moving and very like, I didn't have a firm grasp on numbers and stuff. So I would offer lower than I could. And so I was not as successful as I am now. Having Matthias on my team, we're taking deals down, like getting shit under contract like nothing. So like there is definitely something to be said about going through the whole underwriting. And if it's not you, get someone who's really great at numbers and details that like can focus on that, like the success I'm having, the success that we're having, because we can offer more while understanding that it's going to give good investor returns. It's like we're doing like crazy. So last thing I wanted to say. Otherwise, I'm going to throw this up on YouTube. I'll send y'all the link. Matthias will send me the clean version of this underwriting, and then I will send the link to all of you guys. And otherwise,
Thanks to both of you.
Thank you so much.
Thank you guys.
Thanks, everybody. That was fun. Have a great day. Thank
Great
you.
call.
Thank you.
Thanks, Matthias.
Thank you. Bye-bye.
Bye, y'all.